never knew the son of a bitch even wanted to be a millionaire. Should have thought about that years ago and worked for it.
The 39-year-old man who lives in New York wants to retire at 65. He will get an annual net income of $190,000 from age 65 to 100. Not gross income, net income of $190,000 per year. This tax-free income of $195,000 is equivalent to a gross income of $327,800 for single and $286,800 for a married couple. How is he going to fund his retirement? He is only paying $1,083 monthly, which is $13,000 annually, just for 5 years to fund his retirement, with the initial death benefit is $3.4 million. When he turns 65, his tax-free annual income will be $195,000 until age 100. The total amount of 5 years is out-of-pocket premiums is $65,000. From age 65 to 100, he gets $195,000 annual tax-free income for 36 years, a total of $7,020,000. Why is his income of $195,000 tax-free? It is a policy loan against his cash value. A loan is not taxable income. How is this possible? Arbitrage. Leverage. 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 Many financial groups agree that when used properly, leverage can be a valuable financial tool. Most of us are already using financing when purchasing our homes or other big-ticket items. We are so accustomed to it, we don't consider financing these items as risky. However, when it comes to using financing to make more money, that's when we start to think of financing as risky. But if done in the right way, with the right type of asset and the right type of leverage, we can use it to our advantage and provide more protection for ourselves and our families while providing the potential for more income in retirement. As of today, April 2, 2020, the 12-month LIBOR is 1% and the bank spread is 2.25. So we borrow at 3.25% from the bank and expect the cash to accumulate at 6.95%. 6.95% is not a random number. It is based on the 20 years historical average of 6.23% from the year 2000 to 2019. The 10 years historical average is 7.97%. Combining leverage with life insurance can minimize the risk of borrowing and help accelerate the benefits it provides to us today. In redesigning the typical way life insurance is used, we can reduce the internal costs, allowing us to focus on maximum retirement growth while still providing the valuable protection features life insurance has to offer. Also, by using an index policy, it has the potential for upside growth without the risk of market declines. Premium dollars paid more than the 12 months of policy expenses go into the interest crediting strategies of your choice. Insurance companies can have different types of strategies and can use different indexes like the Dow, Nasdaq, or the S&P 500. Policy expenses include the tax-free death benefit that can also be used in the event you need access to cash in the event of an unexpected critical illness, critical injury, chronic illness, or terminal illness. The S&P point-to-point strategy calculates the interest based on a set period, usually 1 year. The beginning and end of the time period are the 2 points. When the change is positive, your policy is credited interest after applying any caps and participation rates. Here, the market has a positive change and realizes the potential of the market index up to the cap of 11.75%. When the change in your plan is negative, it doesn't impact the cash value in the policy because you are protected by the 0% floor. This 0% floor also protects the bank's money, never exposing the lender's money to the risk of market downturns, providing you more confidence in using leverage. The participant contributes $13,000 after taxes for the next 5 years in this premium financing plan. At the end of the 5th year, the participant's contributions end. The lender then continues funding $113,000 annually in years 6 to 10. After accumulating cash in the policy for 10 years, the participant pays off the lender $1,325,875, which is the principal and interest in any way he chooses. In this example, we have used policy loans to pay off the lender. However, the client can choose to use withdrawn funds from the policy or outside funds to pay off the lender. Once the lender is paid off, the policy is the client's to use how they choose. He is left with $156,346 in his account, along with the death benefit of $2 million. This is an example of a client taking distributions from age 65 to 100. The total amount of 5 years is out-of-pocket premiums is $65,000, with the initial death benefit is $3.4 million. From age 65, he gets $195,000 annual tax-free income for 36 years, a total of $7,020,000. When ready to enroll, determine the amount you want to contribute for the 5-year commitment. Fill out the paperwork, and you are ready for the medical underwriting. No investment advice. The content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial.
You have beaches in Brooklyn.
Yes, but they're just very crowded.
There'll probably be quite a few walkers along here later.
Yes. It's still not the same.